Hello, I'm Kevin Gallagher, Santos Managing Director and CEO. Welcome to this presentation of Santos' 2021 half-year results. I'm pleased to present another strong set of financial results that demonstrate the strength of our disciplined low-cost operating model. Last year, I spoke about the resilience of the business through the bottom of the cycle and how our operating model positions us for growth as the world recovers. We acted on those commitments in March when we took FID on our Barossa gas project offshore Northern Territory. With the major work streams on that project now underway, the next significant step in our disciplined growth agenda will be taking FID on our Moomba carbon capture and storage project. Moomba paves the way for a step change in carbon reduction for Santos and for Australia. At Santos, it means we are able to explore a three-hub CCS strategy that covers Moomba, Bayu-Undan and potentially offshore Western Australia. I have long talked about the energy transition creating significant opportunities for both Santos and Australia to establish a new, large-scale industry producing carbon offsets that will be in significant demand from emitting countries that lack Australia's competitive advantage in carbon storage. While we talk about disciplined growth, the potential merger with Oil Search that is currently going through due diligence creates an exciting opportunity to create a regional champion of size and scale. With the size and scale comes the opportunity to accelerate our aspiration to becoming a clean fuels company and reaching our net zero commitments by 2040. I'll begin today with some opening remarks about our performance before handing over to CFO Anthony Neilson to discuss the financial results in more detail. Before we start, however, I draw your attention to the usual disclaimer. When I spoke to you in December at our Investor Day, I set out 5 strategic priorities for this year, as shown on the slide. I'm pleased to say we have ticked off 3 of these already, and the 4th, to FID Moomba CCS, is on track for the second half as promised. Our first priority, of course, is maintaining a safe and strong base business with a free cash flow break-even of less than $25 per barrel. We want to keep the business functioning efficiently and keep it low cost, and that's what our long life assets with steady production profiles allow us to do. All activities within that base business are self-funded within the rules of our disciplined operating model. The second priority was to take FID on Barossa, which we did in March. Barossa is a world-class LNG project with a very competitive cost of supply into Asian markets. Barossa fits perfectly with our strategy for disciplined growth, utilising existing infrastructure around our core assets. Our third priority is to take FID on the Moomba CCS project. The project is FID ready and we're extremely encouraged by the draft methodology for CCS projects released by the government. We look forward to taking FID once the eligibility for carbon credits is confirmed. The fourth priority was to launch FEED on the Dorado oil and gas project, which we did in June. We plan to develop Dorado in 2 phases, an initial liquids phase, followed by a future gas development, providing supply into domestic gas infrastructure in Western Australia. The fifth priority, and the one we have not been able to progress as planned, was to commence appraisal drilling at Narrabri. While Narrabri achieved state and federal environment approvals last year, an appeal has been lodged against the state approval. A hearing on the appeal is scheduled for later this month, with a final decision not expected until the end of the year. Our clear and consistent strategy combined with a disciplined low-cost operating model underpin our investment proposition. This slide summarises some of the highlights of the first half. I've touched on some of these already, but I would also call out record first half production and sales volumes, which enabled us to increase guidance to the upper part of the range. Our value accretive low cost of supply offshore infill projects at Van Gogh and Bayu-Undan have delivered excellent results with strong initial production rates into our existing infrastructure. Lower unit production costs. I am pleased that our continued focus on costs sees a lowering of our production cost guidance despite cost challenges across the industry. And our very successful maiden debt issue in the US 144A market, where we raised $1 billion at a very competitive long-term interest rate. This was an excellent result for Santos and showed strong support from the capital markets for our disciplined growth strategy and industry-leading ESG position. We remain focused on driving shareholder value by operating and developing low-cost, long-life assets, utilising existing infrastructure, and delivering strong free cash flows through the oil price cycle. This slide summarises the financial results for the half year. Good operational and cost performance delivered $572 million of free cash flow and underlying profit of $317 million, despite lower average LNG prices due to the lagged oil linkage in our long-term offtake contracts. The board has declared an interim dividend of 5.5 US cents per share, fully franked, a significant increase on the previous interim. The dividend is consistent with our sustainable dividend policy, which targets a range of 10 to 30% payout of free cash flow. Slide 6 shows how the business has delivered strong free cash flow over the past 5 years by sticking to the strategy and operating model we announced at the end of 2016. First half sale volumes were a record 53.8 million barrels of oil equivalent. You can see in the chart how the base business is equally split between domestic gas and LNG at 42% each, with liquids making up the remainder. We've delivered over $4 billion in free cash flow since 2016. And to recap, between 2016 and now, we have had to navigate 2 oil price crashes, an earthquake in PNG, a global pandemic, and ongoing government threats of intervention in the domestic gas markets. This demonstrates the strength and the resilience of our portfolio and disciplined low-cost operating model. In 2021, we are targeting a free cash flow break-even oil price before hedging at around $25 per barrel, the same level as last year. At current oil prices, we would generate over $1.1 billion in free cash flow this year. And for every $10 the oil price is above our free cash flow break-even price, the portfolio generates around $330 million US in free cash flow before hedging. Our journey to become Australia's safest operator continues. A core value at Santos is our always safe value. This means that every single day, every person who works at Santos is focused on safety and going home healthy every single day. However, I am disappointed with our safety performance in the first half. We had 3 lost time injuries associated with slips and/or trips. I am very focused on ensuring the lessons from these types of events are learnt across the organisation and that we can continue to drive these incidents lower year on year. Our performance on process safety was much better, with loss of containment incidents significantly reduced to the lowest level in 7 years. In March, we took FID on the Barossa gas and condensate project. Barossa is a tangible benefit of our acquisition of the ConocoPhillips assets in the region. Barossa is also one of the lowest cost new LNG projects in the world and will give Santos and Darwin LNG a competitive advantage in a tightening LNG market. We are targeting a cash cost of production of around $2 per MMBTU, including the FPSO service contract cost. Barossa is basically an offshore scope with an FPSO and a pipeline tied into the existing Darwin LNG plant. Importantly, around 80% of the capital cost is protected under fixed price contracts, so we are not materially exposed to cost pressures seen across the industry. The project is off to a great start, with first steel cut for the FPSO turret in July and manufacturing of subsea flow lines and trees already underway. We are on track for first gas in the first half of 2025. I would like to thank our Barossa partner, SKE&S, for their support in taking FID. We are also finalising the sale and purchase agreement for JERA to acquire 12.5% interest in the project. CCS is the key pathway technology to achieving our medium-term emission reduction targets, with the Moomba project now ready to take FID. All we need is for CCS to be eligible for carbon credit units here in Australia. We're extremely encouraged by the draft methodology released by the Clean Energy Regulator for the qualification for Australian carbon credit units. With that consultation process now complete, everything remains on track for the government process to be completed in the next month, and then we will deliver on our commitment of taking FID on our Moomba CCS project. Moomba is the lowest cost and one of the largest CCS projects globally, as it benefits from existing separation equipment and depleted gas reservoirs with proven rock seal. We forecast a life cycle cost of less than $24 per tonne of CO2. In June, we launched FEED for the Dorado oil and gas project. We plan to develop Dorado in 2 phases, an initial liquids phase followed by a future gas development, providing supply into our domestic gas infrastructure in Western Australia. Entering FEED is a significant milestone and has the project on track for FID around the middle of next year for the Phase 1 liquids development. FID on the second phase of gas development to backfill our domestic gas infrastructure in WA is likely to occur in the second half of the decade. Dorado is a very low CO2 reservoir with approximately 1.5% CO2. With all gas re-injected in the initial phase, makes it one of the lowest emission intensity oil projects in the region. Potential tie-in opportunities to Dorado, starting with the Pavo and Apis prospects to be drilled early next year, could easily be tied back into the Dorado infrastructure and materially increase the value of the project. Santos is committed to a lower carbon future. In 2018, we were one of the first companies in our industry to state an aspiration to achieve net zero emissions by 2050. In 2020, we raised the bar again, setting a new target to achieve net zero by 2040, along with a new medium-term target of a 26 to 30% reduction in our Scope 1 and 2 emissions by 2030, consistent with Australia's commitment to the Paris Agreement. We also committed to work with our customers to help them reduce their Scope 1 and 2 emissions by 1 million tonnes per annum by 2030. We are committed to transparent reporting and disclosure through a suite of ESG reports which you can access on our website. I am pleased to report that we're ahead of our current emissions reduction targets and have set out a detailed and credible roadmap to achieve net zero by 2040 through a combination of large-scale carbon capture and storage, including a proposed Moomba CCS project, nature-based offsets such as our world-leading West Arnhem land fire and abatement programme, and increased use of renewables and energy efficiency across our operations. I will talk more about our CCS plans on the next slide. Our Moomba CCS project paves the way for a significant carbon reduction story for Santos and for Australia. It also means we're able to explore a 3-hub CCS strategy that covers Moomba, Bayu-Undan and potentially offshore Western Australia. This infrastructure footprint potentially provides more than 30 million tonnes per annum of CCS capacity across 3 Santos operated hubs. Moomba will be first project to hit the go button, but I am especially excited about the potential we have to repurpose Bayu-Undan as a CCS hub for the region. We estimate a storage capacity of around 10 million tonnes of CO2 per annum in Bayu-Undan once production from the field ceases. Our studies indicate existing wells and pipeline can be repurposed for CO2 service. I would remind you that at Bayu-Undan project startup, over 1 BCF of gas a day was injected into these high permeability reservoirs, so they are some of the best offshore reservoirs in the region for gas injection. Biowind and CCS could contribute to decarbonising Barossa from project startup, as well as opening up other resource opportunities in Northern Australia. We look forward to working with our joint venture partners and our host governments to bring this exciting project to fruition. The proposed merger with Oil Search is consistent with our disciplined strategy to grow around our 5 core assets. It represents a compelling combination of 2 industry leaders to create an unrivaled regional champion of size and scale, with a unique diversified portfolio of long-life, low-cost oil and gas assets. The merged company would have strong cash generation from a diverse range of assets, which provides a strong platform for sustainable growth and shareholder returns. The merger also builds on our industry-leading approach to ESG through the combination of Santos' net zero pathway with Oil Search's unique social and community investment in PNG. You have heard me say before that I believe our industry must be in a position to self-fund growth and the energy transition to cleaner fuels. I believe the merger will create a company which is better placed to achieve this goal than either of us stand alone. I also believe the merger will unlock material shareholder value in 3 key areas. First, substantial combination synergies to the benefit of all shareholders, using Santos' proven ability to deliver incremental value. Second, through partner alignment in PNG to unlock incremental value, just as we've achieved at Darwin, LNG and Barossa with the Conoco acquisition and subsequent sell-downs. And third, options and flexibility for portfolio optimization in the merged group, including continuing with Oil Search's sell-down process in Alaska. This slide sets out a high-level overview of the process to deliver the proposed merger. We are currently undertaking exclusive due diligence on each other and expect this will be complete by the end of this month. That will position us to sign a binding merger implementation deed. We are targeting to have the scheme vote and all approvals in place before the end of the year, which will position the merged company to hit the ground running at the start of next year. Santos has a proven track record of delivering integration synergies from acquisitions. The Quadrant and ConocoPhillips acquisitions have delivered over $160 million in synergies from areas like duplicated overhead and corporate costs, and OPEX and CAPEX savings through the application of our low-cost operating model. For the Oil Search merger, we will use the same approach and team, which we expect will deliver significant synergies for the benefits of all shareholders. We will be able to provide further guidance on potential synergies once we have completed due diligence. Something I've been very pleased with this year has been our success in delivering incremental value from assets that we have acquired. In the case of both Biowind in Phase 3C and Van Gogh Infill Phase 2, these are projects that represent upside value over and above our acquisition cases. They are perfect examples of our strategy to deliver incremental value from short cycle, low risk opportunities around our core assets using existing infrastructure. Both projects have delivered better than expected reservoir outcomes and strong initial flow rates from the first wells. We look forward to completing the remaining 4 wells on these projects over the course of the second half. This focus on driving incremental value from assets is something we will bring to the Oil Search merger. In summary, it was a strong start to the year for Santos despite the challenging external environment. The business is running well and our operating model sets us up for disciplined growth. The potential merger with Oil Search creates an exciting opportunity to create a regional champion of size and scale. With size and scale comes the opportunity to accelerate our aspiration to becoming a clean fuels company and reaching our net zero commitment by 2040. I'll now hand over to Anthony to provide a detailed review of our financial results.
Thanks, Kevin, and hello to everyone. Santos delivered another strong set of financial results for the first half of 2021. I'll go through these in more detail over the next few slides. The three key financial priorities for the business have not changed. Firstly, we continue to focus on generating free cash flow from the base business. As Kevin previously stated, we achieved strong free cash flow of $572 million in the first half of 2021 as commodity prices have recovered and cost savings flowed through, with the average realised crude oil price increasing 45% compared to the first half of 2020. We are on track to deliver a 2021 free cash flow break-even price of less than $25 per barrel before hedging. In 2021, the business will generate approximately $330 million in free cash flow for every $10 per barrel increase above our break-even price. At current oil prices, the base business would be generating more than $1.1 billion of free cash flow this year. The second priority is ensuring that our capital allocation process is disciplined during our next growth phase. As previously announced, we've commenced a process to explore market interest in a Dorado non-operated equity interest. In Northern Australia, the sell down to JIRA for 12.5% of the Barossa project is progressing well and is expected to complete in the second half of 2021. And finally, Santos' balance sheet has strengthened in readiness to fund our growth projects. In April this year, we issued a $1 billion 10-year senior unsecured fixed rate bond in the US 144A Reg S market, taking our liquidity to around $4.5 billion. Strong cash flows have reduced net debt, with gearing at 31.8% at the end of June. At the current oil prices, by the end of the year, gearing would be around 30%. This is consistent with our disciplined operating model rule to reduce gearing to the 20 to 30% range through the cycle. This slide shows a strong set of results for the half year. Sales revenue increased 22% to just over $2 billion, which is a record for the first half. Higher oil and gas prices and increased sales volume led to an EBITDAX of approximately $1.2 billion, up 24%. Underlying net profit after tax of $317 million was 50% higher than the first half of 2020. However, this was impacted by higher depreciation, primarily in Western Australia, driven by the previously announced reserve revision at the Reindeer gas field in 2020. Free cash flow was up 33% to $572 million, and the declared dividend of 5.5 US cents per share, fully franked, is consistent with our sustainable dividend policy at 20% payout of free cash flow. The resilience of our diversified portfolio throughout the commodity price cycle is best highlighted through free cash flow generation. The chart on the right-hand side shows oil price and free cash flow, which is 33% higher than the first half of 2020. Operating cash flow increased 12% to $942 million, predominantly driven by higher oil and gas prices. The trend in earnings metrics is a similar story to cash flow. The business is resilient, with EBITDAX returning to 2019 levels of $1.2 billion, despite the challenges that remain as a result of the pandemic. Our diversified portfolio of 5 core assets comprising fixed price domestic gas contracts, strong LNG contracts and liquids underpin a strong underlying first half profit of $317 million. These two charts show production and sales volume since the first half of 2016. In 2021, both were records and higher than prior year due to increased equity in Bayu-Undan and Darwin LNG, higher oil and domestic gas production in Western Australia, and continued strong performance from the GLNG upstream fields. Volumes are expected to be lower in the second half due to the 25% sell down in Bayu-Undan and Darwin LNG to SK, which completed at the end of April. Full year production guidance is maintained at 87 to 91 million barrels of oil equivalent and sales volume at 100 to 105 million barrels of oil equivalent. Our focus on safe, low cost and efficient operations is continuing to drive cost reductions, which is reflected in the group unit upstream production costs of $7.97 per barrel of oil equivalent. Since obtaining operatorship of Bayu-Undan and Darwin LNG in May last year, we've delivered more than $100 million of pre-tax synergies, which is reflected in a 30% reduction in upstream unit costs in Northern Australia compared to the 2020 full year. These cost savings are partially offset by increased costs associated with managing COVID-19, particularly for quarantine requirements to ensure that we could maintain production. At group level, COVID-related costs added 35 cents per barrel of oil equivalent. As flagged at our full year results in February, the stronger Australian dollar FX rate also added around 55 cents to each barrel produced, when normalised for the average exchange rate in 2020. So, given the headwinds of these extra COVID-19 and FX pressures, this is a good result for production costs. These charts show how the operating model continues to drive strong results across our operated assets. We have maintained our focus on low cost and efficient operations. The operating model continues to deliver both a low portfolio free cash flow break even, and we are targeting less than $25 per barrel excluding hedging in 2021. As the charts show, cost reductions are occurring across our offshore assets, and this is reflected in the group unit upstream production costs for the base business. Our onshore business has delivered underlying cost reductions which were offset by COVID-19 related costs, foreign exchange movements and lower first half volumes in the case of Cooper Basin. This table shows a snapshot of the half year results outlining the strength across our 5 core assets and the balanced nature of their contributions to EBITDAX and margins. Western Australia, Northern Australia and PNG are our highest margin assets with strong stable cash flows, low costs and margins in excess of 75%. This really emphasises the value that can be added to the portfolio through our strategic value add acquisitions in both Western Australia and Northern Australia. A combination of COVID-related costs and FX impacts have increased the Cooper Basin unit production costs by 90 cents per barrel of oil equivalent. Despite these challenges, the Cooper Basin EBITDAX margin is maintained at 42%. All our core asset segments have margins greater than 40%, and overall our group EBITDAX margin remains strong at 58% for the first half. We continue to drive costs out both through the operating model and synergies from the Quadrant and Conoco acquisitions, which are reflected in these lower unit costs. 2021 CapEx guidance is unchanged at around $1.6 billion, comprising $900 million in sustaining CapEx and around $700 million for major growth. We've now commenced all the major work scopes for the Barossa projects, which will drive higher major CapEx in the second half of the year compared to the first. For our onshore division, drilling activity is less than previous years due to COVID-19 and joint venture budget constraints, resulting in the phasing of more activity in the second half of 2021. In the Cooper Basin, we've recently added a 4th rig to the program, which will be primarily focused on drilling horizontal oil wells to offset natural field decline and deliver incremental production in 2021. For the GLNG upstream fields, while we were planning to drill approximately 180 wells across the acreage in 2021, we expect to increase the number of wells to around 350 next year to support continued strong GLNG upstream production. At Investor Day last year, we introduced our portfolio of midstream infrastructure assets comprising Moomba, Port Bonython, Darwin LNG, Varanus Island and Devil Creek, and provided visibility to stable and material cash flows generated by existing tolls. In the first half of 2021, EBITDA for these assets was $217 million, which supports over $400 million for the full year. We're also targeting cost savings of $60 million per annum by 2025 to further improve margins. TotalEnergies' recent GLNG infrastructure deal provides an anchor point for value and implies a similar midstream deal over Santos' 30% share of the GLNG plant would be worth around $820 million. On a like-for-like basis, assuming the same toll, EBITDA for GLNG would be around $95 million US per annum. The TotalEnergies transaction shows that latent value in our midstream portfolio, which could have an EBITDA of more than $500 million if GLNG was included. In addition, there are further opportunities including Macedon, a second train at Darwin and carbon capture and storage. Net debt was $3.4 billion at the end of the first half, including a $417 million lease liability under AASB 16. Gearing has been reduced to 31.8%, which includes the lease liability, and we are on track to reduce gearing to 30% by year end, assuming the current oil prices. There is liquidity in place of approximately $4.5 billion, comprising $2.4 billion in cash and $2.1 billion in committed undrawn debt. In July, we used some of this cash to repay $452 million in debt, with 2024 maturities now reduced to $719 million. With a strengthened balance sheet, we are ready to fund our growth projects, and we have flexibility to optimise the portfolio through farm outs and disposals. In closing, the disciplined free cash flow focused operating model continues to drive shareholder value through lower costs, improved capital efficiency and increased returns. We are maintaining a free cash flow break even for 2021 at less than $25 a barrel before hedging and delivering strong free cash flow in this improving oil price environment. The balance sheet is well positioned to fund our growth projects, provide sustainable dividends, and we are well positioned to deliver this next phase of growth. Thank you, and I'll now hand back to Kevin.
In summary, as I said at the outset, I'm very pleased to present another strong set of financial results and record production and sales volumes. The business is performing well, as you can see in the additional slides in the asset performance section of the presentation released today. We have been and remain unrelenting in sticking to our strategy and implementing our disciplined low-cost operating model, an operating model that has proven its value by delivering consistent results, keeping the business resilient and performing strongly. We continue to generate strong free cash flows, maintain the strength of our balance sheet and provide dividends to shareholders. And the proposed Oil Search merger provides a compelling combination of two industry leaders to create an unrivaled regional champion of size and scale with a unique diversified portfolio of long life, low cost oil and gas assets. Thank you for watching.